Something very interesting is happening in the silver market right now, and most investors are only looking at the price chart. Silver is pushing toward the $70 level, but underneath that move, there is another story developing inside the COMEX silver market. COMEX is where silver futures are traded, and while most futures contracts never result in physical delivery, the relationship between open contracts and the amount of silver registered for delivery is something serious silver investors watch closely. The reason is simple. When strong investment demand, industrial demand, and physical delivery interest all increase together, the physical side of the market can become much more important. And with silver approaching $70, the next major target is already coming into focus: $80. To understand why COMEX matters, we first need to understand what actually happens inside the system. COMEX is not simply a warehouse full of silver, it is a futures exchange where buyers and sellers trade standardized contracts. A standard COMEX silver futures contract represents 5,000 troy ounces of silver. Most traders never take physical delivery. They close their positions, roll them forward, or settle financially. But some participants do want physical metal, and those delivery contracts become especially important during active delivery months. That is why investors watch COMEX inventory reports, open interest, delivery activity, and the amount of silver currently registered for delivery. And this is where the difference between registered and eligible silver becomes extremely important. Registered silver is metal that has been placed into the category available to satisfy delivery obligations. Eligible silver meets the exchange's requirements and is stored in an approved vault, but it is not currently registered for delivery. So when you hear about total COMEX silver inventory, you cannot assume that every ounce is immediately available to satisfy a futures delivery obligation. Recent inventory data showed roughly 99 million ounces of registered silver and around 238 million ounces of eligible silver, giving total inventory of roughly 337 million ounces. The important point isn't that COMEX is simply running out of silver. The more useful question is how much metal is actually registered and how that number changes as delivery demand develops. Now look at the futures market. Recent data showed more than 52,000 September silver contracts open, representing roughly 264 million ounces of potential contract exposure if every contract were eventually delivered. Of course, that does not mean 264 million ounces will suddenly be demanded physically. Most futures contracts will never reach that point. But the comparison between open interest and registered inventory helps investors understand why delivery activity is being watched so closely. When more participants choose to stand for delivery, the market has several ways to respond. More silver can move into registered status, existing positions can be closed or rolled, or prices can rise until buyers and sellers reach a new balance. That last part is particularly important for a bullish silver story because rising prices can attract additional supply while also creating stronger momentum among buyers. The physical silver story makes this even more interesting. Silver isn't only an investment metal, it is also an important industrial material used in electronics, electrical applications, solar technology, medical equipment, and many other industries. That means silver demand can come from completely different directions at the same time. Investors can buy silver because they expect prices to rise, while manufacturers need silver because they actually use it. When those two sources of demand strengthen together, the market becomes much more sensitive to available supply. And unlike a financial asset that can be created quickly, new silver production takes time. Mines require exploration, financing, development, construction, and years of work before additional production reaches the market. This is one reason silver can become extremely powerful during a strong bull market. Higher prices don't automatically create new supply overnight. A mine cannot suddenly double production because silver moved higher this month. A large portion of silver production also comes as a byproduct of mining other metals, which means silver supply isn't always directly controlled by the silver price. So when demand grows faster than available supply at current prices, the market has to search for a new equilibrium. And the easiest way for that to happen is through higher prices. Now consider what is happening with silver itself. The metal has moved aggressively toward the $70 area, and that level is extremely important psychologically. When an asset approaches a major round number, traders and investors start watching it closely. A successful breakout above $70 can change the market's psychology because $70 stops being the ceiling and starts becoming a potential support area. Once that happens, the next obvious target becomes $75. And if silver can establish momentum above $75, the market naturally begins looking toward $80. That's why $80 isn't just a random prediction. It is the next major psychological milestone after the level silver is currently testing. There is also a recent COMEX development that deserves attention. On August 20th, CME announced that it suspended the approved status for warranting and delivery of a specific Chinese silver brand produced on or after August 20th, 2026. Silver produced before that date remains eligible for warranting and delivery. This does not mean COMEX has stopped accepting silver or that the exchange is running out of metal, but it is another reason market participants are paying attention to the details of approved silver brands and delivery eligibility. When the rules around deliverable material change, traders naturally look more closely at the physical side of the futures market. This is why I think the COMEX story should be viewed as part of a much bigger silver story. We don't need to claim that COMEX is about to collapse or that every futures contract will demand physical silver. The more interesting argument is that the market is becoming increasingly sensitive to physical availability while silver prices are already moving higher. If delivery demand remains strong, registered inventory becomes more important. If industrial demand remains strong, more physical metal continues moving into manufacturing. If investment demand keeps increasing, more buyers compete for available supply. Put those forces together, and the bullish case becomes much more compelling. And then there is the investment side of silver. Once prices start breaking major levels, investor attention tends to increase rapidly. Someone who ignored silver at $50 may start watching it at $70. Someone who missed the initial move may enter when the chart breaks resistance. Momentum traders can also become more active as new highs attract attention. This is how a commodity can move from being a niche investment story into a mainstream market narrative. The higher silver climbs, the more people begin asking where the next target could be. That is exactly where gold can also help silver. Gold has been extremely strong, and when gold continues making higher highs, it creates a supportive environment for the broader precious metals sector. But silver has an additional characteristic. It can move more aggressively than gold during strong momentum periods. Gold is the larger and more established monetary metal, while silver has both monetary and industrial characteristics. When the precious metals sector becomes strongly bullish, silver can attract investors looking for greater percentage upside. That is why a move from $70 toward $80 can become very interesting if the broader metals market remains strong. Another factor worth watching is the gold to silver relationship. When gold leads and silver starts catching up, the silver move can become increasingly powerful. Investors begin comparing the two metals and looking at whether silver is undervalued relative to gold. That can create another source of demand. If gold continues pushing higher while silver breaks through $70, the combination can reinforce the idea that the entire precious metals complex is entering another strong phase. But let's come back to COMEX because that's the real focus of this video. The most important thing to monitor is not one single inventory number. Watch the trend. Watch registered silver. Watch eligible silver. Watch delivery notices. Watch open interest. Watch how much silver moves into or out of registered status. Watch the relationship between futures positioning and physical availability. Those changes can tell us much more than simply looking at the headline price every day. And when those physical market indicators start moving alongside a strong price breakout, the signal becomes much more interesting. Now imagine the bullish scenario developing step by step. Silver breaks above $70 and holds the level. Buyers become more confident, investment demand increases, industrial demand remains strong, COMEX delivery activity stays elevated. Registered inventory remains closely watched. More investors begin focusing on the physical market. Momentum continues building. Silver then moves towards $75. At that point, $80 becomes the obvious target. The market doesn't need a dramatic shortage for this to happen. It simply needs demand to remain strong while available supply becomes more valuable. And that's the key point. A bullish silver market doesn't require the COMEX vaults to become empty. It doesn't require every futures contract to demand delivery. It doesn't require a complete breakdown of the futures system. What it needs is a market where buyers are willing to pay progressively higher prices to secure the silver they want. As prices rise, available metal becomes more valuable, and that can create a feedback loop where stronger momentum attracts even more investment interest. This is why the $70 level matters so much right now. Silver is no longer trying to recover from a small move. It is approaching a major psychological threshold after a powerful run. A clean move above $70 would give the bulls another important technical confirmation. From there, $75 becomes the next milestone, and $80 becomes the bigger objective. The closer silver gets to those levels, the more attention the market is likely to receive. So what should silver investors watch from here? First, watch whether silver can establish itself above $70. Second, watch COMEX registered inventory and delivery activity. Third, watch industrial demand, particularly from solar and electronics. Fourth, watch investment demand and broader precious metals momentum. And finally, watch the relationship between gold and silver. If gold continues rising while silver begins accelerating, that would create an especially powerful environment for silver bulls. The most important takeaway is that COMEX is only one part of the story. The real opportunity comes from understanding how the futures market connects with the physical market. Registered silver tells us about metal currently positioned for delivery. Eligible silver tells us about metal held inside approved vaults but not currently registered. Open interest shows us the scale of futures positioning. Delivery activity tells us how much physical settlement is actually being requested, and the price tells us how the market is balancing all of those forces. Right now, all eyes are moving towards $70. If silver clears that level and momentum remains strong, $75 becomes the next major checkpoint. And once $75 is broken, the conversation becomes very simple. Can silver reach $80? Given the strength we've already seen, the combination of investment demand, industrial demand, precious metals momentum, and growing attention around the physical silver market makes that target extremely interesting. So I wouldn't focus on the sensational question of whether COMEX is running out of silver. That's not the real story. The real story is that silver is becoming more valuable while investors are paying much closer attention to physical availability, delivery activity, and the amount of metal actually registered for futures delivery. At the same time, industrial users continue consuming silver, investors continue watching the precious metals market, and the price is approaching a major breakout level. That combination is what makes this setup so exciting. Silver is approaching $70. The next major level is $75. And after that, the bulls have their eyes on $80. COMEX is giving investors another reason to pay attention, but the bigger story is the combination of physical demand, industrial consumption, investment interest, and powerful price momentum. If those forces continue working together, silver could be entering another major stage of its bull market. The market has already made its move towards $70. Now the question is how much further the momentum can carry it, and if the bulls remain in control, $80 silver may not be the end of the story. It could simply be the next major milestone.